I did it recently also just for the US. And instead of it being around 38,000 to 40,000, whatever that number was, it was something like $135,000.
Yeah.
So if you're doing the calculation based on $38,000, but the true fundamental value in your country is 135, you're very, very covered in any outcome, because that's what we try and do. What if I'm right? What if I'm wrong? Let's cover both, so it just doesn't matter.
If you understand what a derivative is, that the purchasing power of the dollar comes from its origin as a gold derivative, and therefore it still is that, because all the inflation, all the other stuff is on top of the gold layer. It's not in place of it, it's on top of it.
Confidence in paper wealth looks increasingly fragile when measured against the deeper monetary role of gold and silver. The discussion centers on a simple but powerful idea. Market prices may not reflect true underlying value when currencies have been stretched by debt, derivatives, and years of monetary distortion. In that setting, precious metals are not just commodities, but financial protection against a broader loss of trust. Building on this perspective, Lynette Zang, a seasoned monetary analyst, and Rafi Farber, a staunch defender of gold and silver, sound the alarm. The system still relies on a hidden gold-based structure, even if it is largely ignored. Their urgent message, inflation, debt excess, and false pricing have stacked immense instability over once solid ground. This is why gold must be seen as a vital financial bedrock, with silver poised for explosive moves when the reset hits. As markets move toward fundamental valuation, precious metals, especially gold, could see dramatic repricing. Gold may be valued far beyond today's expectations, and silver could benefit as physical demand overtakes paper suppression. This underscores the importance of viewing gold and silver as financial protection in times of monetary uncertainty. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
How can the COMEX have 1 ounce of silver when there's been $10 arbitrage for months? This makes no sense to me. I'm beginning to think the COMEX is neighbors with Fort Knox. Yeah, they are. And actually, that was one of the holes, and I told you this,
right,
that I promise you, because I realize that you guys don't really understand the spot markets, but it's simple, really, because the COMEX is all about contracts, whether it's one contract that controls 500 ounces or 250 ounces. And of course, they want to democratize the markets, which means transfer the risk to you. You could buy 1 ounce contracts now, right? So if you can just have 1 week worth of patience, unless something major happens between now and next Tuesday, then I will explain it, and I will show you, and I will give you links so you can do your own follow-up with that. Because this is really important for you to know. How many times can you be lied to and you do not know the truth?
Yeah, exactly. And it's just, like you said, it's a manipulated paper market. If there's nothing physical backing it, they can rehypothecate it, they can suppress the price, they can do whatever they need to do to simply just, serve their best interests, not ours.
If you only had $1,000 to buy metals, would it be better to buy gold or silver? I think they can do a bit of both with $1,000, right?
Yep.
You can do a bit of both, and I would do both. You need both. Gold is the primary currency metal. It is what all other currencies are valued against in a reset. Silver is the secondary currency metal. We've talked a lot about that gold-silver ratio and how that can start to shrink, but once we hit hyperinflation, then it grows wider again. So it absolutely will maintain your ability to purchase the same foodstuffs over time. They actually execute that overnight revaluation. And remember, every single central bank has a gold revaluation account. How much more debt have they grown? A whole lot more than any other gold finds that they may have, right? So yeah, in terms of dollars, but what do you think you're going to buy with those dollars by the time they go to fundamental value? Same thing as my $10 trillion Zimbabwe note. Nothing. All confidence will be lost. But 33 different global users, 36 different global users. It's just supply and demand dynamics. It's not rocket science. It's just supply and demand.
Yeah.
But yes, Mr. Money, you're absolutely right. All those numbers coincide with the 84,000 in terms of dollars. And you can buy it at what? 4,800 was where spot was earlier when I was looking somewhere in that vicinity. Yeah. Right? So, yeah, it's a bargain. It's a bargain.
The conversation also highlights a growing distrust of paper pricing, especially in silver. When large price gaps and persistent arbitrage persist, yet official market structures still appear stable, it raises deeper questions about how much real metal actually backs the contracts. That disconnect is what keeps many hard asset investors focused on physical ownership rather than paper exposure. Another important point is allocation. The message is not to choose gold or silver as if only one matters. Gold offers core monetary protection and long-term stability, while silver adds a more volatile but potentially more explosive component. In a period of currency stress, both can serve different purposes within the same strategy. There is also a warning embedded in this view. Once confidence in fiat purchasing power begins to crack, nominal gains in currency terms may matter less than the preservation of buying power. That is why the focus stays on what metals can still buy when paper wealth loses credibility. Let's get back to the interview.
So that's what our baseline is for the strategy, is what is the fundamental value of an ounce of gold and an ounce of silver. It starts with that barter position, knowing how much silver would be able to get you and your family and even your community through this period of hyperinflation, based on wanting to make sure essentially your daily life goes uninterrupted while the dollar collapses. That's what the barter position is for. And so we look at what is your personal expenses, how much do you have going out, and how much is property taxes, how much for insurances, things like that we look at, again, because the strategy is it's custom tailored to you. The next portion of that is the debt getting paid off. So according to what you have on your personal ledger, what debts you have, we then just look at that fundamental value, and we say, based on this is how many ounces of gold you would have to dedicate to paying off that fixed rate debt and getting debt free when they do that first overnight revaluation.
And that's today. When we're talking about fundamental value, we're taking a look at the level of debt versus the level of gold, and that's how we determine it. But it's extraordinarily conservative, because what that does not take into account are all the levels of leverage that are on top of that debt, plus all of the new debt that they will create in the future. So if we determine what the fundamental value is the day that you call in and set up what you need to understand that's a very conservative position. We don't know how much more debt they're going to accumulate, but the reality is desperate governments do desperate things, and that's the only tool they have, is more money printing. So to be very conservative with it, that's how we determine the fundamental value. By the time you're going to execute it, what might take 10 ounces today might take an ounce at that time, because of how much, in terms of, in this country, dollars, but this is true anywhere in the world, how much more debt they've grown.
Yeah.
Because, I do it globally because this is a global issue, so we need to know globally.
Yeah.
But I did it recently also just for the U.S., and instead of it being around 38,000, 40,000, whatever that number was, it was something like $135,000.
Yeah.
So if you're doing the calculation based on $38,000, but the true fundamental value in your country is 135, you're very, very covered in any outcome, because that's what we try and do. What if I'm right? What if I'm wrong? Let's cover both so it just doesn't matter. But anything that's marked sterling silver or 925, so in jewelry form, picture frames, forks and spoons, doesn't really matter. That's 92.5% pure. If you have any gold, 9 carat, 14 carat, 18 carat, 22 carat is mostly what jewelry is made of. That's all recoverable. And yeah, you can start with a little bit of silver. Like I said, we have a 1 ounce minimum, and I can't really speak to some programs that we're working on, but there's always a way to accumulate. Well, they could do an overt confiscation of monetary gold, right? They can put even higher taxes on it, which is why it's so important at a state level to get more and more states to adopt gold and silver as legal tender, so that we're approaching it from a grassroots level and also a governmental level. Because as we saw with cannabis, if enough states do adopt it as legal tender, then that will put pressure on the federal government to also adopt it as legal tender. But, governments, if a revaluation does happen, before the revaluation happens, they would be doing the confiscation.
If you understand that metals are money, if you understand what a derivative is, that the purchasing power of the dollar comes from its origin as a gold derivative, and therefore it still is that, because all the inflation, all the other stuff is on top of the gold layer. It's not in place of it, it's on top of it. So you have gold and you have all this inflated debt on top of that. But when that goes away, like if the debt goes away because people can't pay it, the gold is still there, and so is all this stuff that's available for purchase. So then what happens is the debt can't buy anything, and the paper is mostly debt, and it's a little bit of gold, but gold is all gold and no debt. So all of the purchasing, knowing that all the purchasing power at the collapse of a currency will flow necessarily into gold, and by extension silver, because silver and gold are related.
This discussion demands urgent attention because it centers on survival through profound monetary upheaval, not just fleeting trading thrills. Building on earlier themes, the core message is clear. Investors risk grave misjudgment if they assess metals only by comparing today's spot prices with yesterday's headlines. The critical question is how gold and silver will perform when faith in debt-backed currency systems collapses. In this context, speakers sound the alarm. There is a sharp distinction between price and value. A currency may continue circulating even as its purchasing power erodes beneath the surface. However, when confidence shatters, repricing can erupt almost instantly. In such a precarious environment, gold emerges as the anchor asset, regarded as the metal against which all currencies are ultimately measured. Meanwhile, silver's volatility takes on new gravity if physical shortages, surging demand, and eroding trust in paper contracts converge all at once. The prediction embedded in this outlook is clear. A reset in confidence could send gold into a much higher valuation range and pull silver sharply upward with it, though not necessarily in a smooth line. For those preparing early, the goal is not speculation alone, but preserving real purchasing power. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.